In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
So let's break down why the stock market is a casino in the short term, but not in the long term. Stocks represent tiny pieces of a business, and the price of those stocks reflect the value of the underlying business. But here's the thing, it takes time for a company's value to really go up, and in the short term, it stays pretty much the same. When you buy and sell those stocks quickly, like in a few days or weeks, it's like a casino, where one person's gain is another person's loss. Why? Because you're trading something that hasn't changed much in value, but just at different prices. But here's the twist. Over a longer period, say years, the company's value can actually grow. And when that happens, the actual worth of the stock goes up, which is reflected in the stock price. So as John Bogle said, in the short term, the stock market can feel like gambling because people are trading stocks at different prices without much change in the actual value. But in the long run, it's like a money-making machine, and that's because of the growing value of the companies behind the stocks.
Investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing.
Over the past 50 years, the US stock market has given an average return of around 10.5%. Imagine this, if someone had put $1,000 into the market every month for 30 years, from 1993 to 2023, they would have a whooping $2.5 million. John Bogle's advice is to not try to guess when the market is at its peak or the lowest point, because that's super hard to predict. Instead, he suggests consistently investing in the market over a really long time. This way, you're more likely to achieve your financial goals in life.
Well, the consequence of that is that the one that's indexed, a dollar will produce about $30 at 7%. And the one that's not indexed, and you're paying 2%, a dollar we created about $10 at 5%. That's the 7 minus the 2. So that means that you put up 100% of the capital, you've taken 100% of the risk, and you've gotten 33% of the return.
In this video, John Bogle is talking about how those management fees can seriously eat into your long-term returns. Let's break it down using the S&P 500 over the last 30 years. If you had put $1,000 into S&P 500 every month from 1993 to 2023 with a solid 10.5% return, you would end up with $2.5 million. Now, if you went for an actively managed mutual fund instead, and if it gave you 1% lower return of 9.5% after factoring in all the fees, your ending amount would be $2 million. That 1% less in performance might not sound like much, but over 30 years, it could cost you $500,000. So those fees that the funds charge are a big deal and can make or break your investment success over the long haul.
I think the most important thing you need to know about the performance of the stock market in the next 30, 40, 50 years is what is the GDP of the United States going to do. Corporate profits are correlated at 96%. S&P dividends are correlated at 96% with the GDP of the United States. The GDP doesn't grow quite as fast, but not a big difference, 6.7 compared to 7.5 or something like that.
GDP, or gross domestic product, is the measure of the total goods and services produced by a country. And large corporations listed on the stock exchange are a major contributor to the total economic output of a country. So in a nutshell, the stock market is a reflection of the underlying economy of a country. And as John Bogle said, there is a 96% correlation between the GDP growth and the growth of the stock market. However, one interesting fact is that more than 30% of revenues of companies listed on the S&P 500 comes from international markets such as Europe, China, Japan, and so on. So the growth of S&P 500 is tied not only to the growth of US GDP, but also to the growth in GDP of major international markets.
The first thing and the unchanging rule and the simple rule is think about asset allocation. How much in stocks for growth with a lot of risk that comes with it, how much in bonds with income and a fair amount of safety that comes with them. And balance off those things. And I use this rule. I've used it for, I don't know, 25, 35 years, certainly as long as I can remember.
When it comes to deciding where to put your money in safer assets like bonds or riskier assets like stocks, there is no one-size-fits-all answer. It really depends upon 5 main factors: your age, your risk tolerance, your life goals, your profession, and your current financial situation. Now, bonds are considered a safer option because they give you a steady and predictable income. But the returns that you get from bonds are lower than what you could get from stocks in the long run. Stocks can generate more returns over a very long time, but the price can hugely fluctuate in the short term. And you might hit a time when the market isn't doing so well, but you might need cash for something very important. So, as John Bogle said, as your age and risk tolerance decreases, you should think about increasing the proportion of bonds in your asset mix compared to the more volatile stocks.
Activity is essentially the curse of Wall Street. If there's no activity in Wall Street, there is no money in Wall Street. Every day, all those $30 trillion of stock that's traded changes hands, something like that. One person's buying, one person's selling. It creates no value. It shifts value from A to B or from B to A, and the system of Wall Street takes its cut out of the middle. So the gambling, the casino comes up again. You know, the croupiers of Wall Street, like the croupiers of Vegas, as it's called, I believe it's Las Vegas.
When stocks are being bought and sold on the stock market, it is good news for 3 major entities: the stockbroker, who earns a brokerage from every trade; the media, that is trying to sell you the latest stock gossip; and the government, who gets their share through taxes on every trade. But for regular people who put in their hard-earned money, it is not that great. When you trade stocks very frequently in the short term, you are not really creating any new value. You are just passing the same value back and forth for different prices. The real value of a company takes a long time to go up, but in the short term, the stock prices can fluctuate a lot more than the actual value of the underlying business. So in a nutshell, all this trading activity is great for the middlemen, but for regular investors like us, it is not a great move. Staying invested for the long term and not constantly buying and selling is actually the best move. It helps you build wealth over the long haul and prevents you from getting ripped off by the middlemen.
Will a value-weighted index do better? Will a dividend-weighted index do better? Probably it will do better some of the time. I do not believe it will do better in the long run. That remains to be seen. But when you think about it, if, let's say, fundamental indexing, whatever that means exactly, but a weighting by some company, corporation data rather than by market price, still owns essentially all the stocks that the S&P 500 owns, which is somewhat different weights. Not huge, but somewhat different weights. So they may do better, they may do worse. But if they continue to do better, well, what will happen? Everybody will take their money out of the market-weighted index and put it into the value-weighted index, and then the opportunity will vanish. That's the way the markets work. I don't think it's going to work, and I don't think that it's worthwhile to add that risk.
So John Bogle is basically talking about how certain styles of investing, like value investing or growth investing, go through cycles in terms of performance. People in the investing world often debate about which approach is better. But if you look at the chart, you'll notice that over the past century, there have been times when value investing did better, represented by those gray bars, and there have been times when growth investing did better, represented by those yellow bars. Recently, since 2008, growth investing has been doing well. As you can see, more yellow bars since 2008. But here's the catch though. As John Bogle points out, when one approach does really well for a while, investors tend to move their money into that approach. And this popularity can lead to that approach being overinvested and cause it to underperform in the next period. So investing styles outperform in cycles, and past performance is no guarantee of the future results.